We will begin shortly. Hi, I'm Realtor.Leaven with Keller Williams Realty, and today's webinar is going to be about buying a home in a seller's market. It's very important that you understand what you're up against before you enter the market so you're not surprised. So I wanted to create this webinar so you would understand. So let's get started. So agenda. So I'll talk a little bit about me. What is a seller's market? We'll look at an offer from a listing agent point of view, and I'll point out the pluses and minuses because I've actually been on both sides, so I can explain to you so you know basically what it is on the other side of things, from you being a buyer to what's actually happening, but quote unquote behind the scenes that you don't know about. Property showings and contingencies. So I've been in real estate for over 15 years. This year will mark 18 years if you're watching this in 2020. So I've seen all kinds of markets, the good, bad, and the ugly. It can get very interesting in our market, especially in the DMV. But I've seen it all, so I'm here to stay. So that's why I wanted to make this educational video so you know whether it's the right time for you to buy or you need to wait. So it's important to know if you must buy a home this year, what are you going to be up against, and what are the necessary steps that you need to take to be able to compete, because it is a competition. It's a sprint. It's like how fast you want to go though. So let's talk about it. So what is a seller's market? So a seller's market is everything is fast paced, is high demand. So there are not enough properties to meet the demand of the current buyers. So it's limited inventory. So it may be in a city, there may be, if you are looking for a certain thing, you say, okay, well, I want a 3-bedroom, 2.5 bath, and it has to have a 2-car garage. There may only be 5 in that city that you want to purchase in. And if you've seen all 5 of those and nothing else comes on the market, either you'll have to change your criteria or move to another city. And if you're not open to another city, then we'll just have to wait until it's another property. But let's say one of those 5 you actually do like. So then you would be in a bidding war. So at that point, you would have to submit your highest and best. The highest and the best you can do. So don't submit an offer and say, oh, well, let's do 300,000 and then we can see if they'll pay closing costs, because to see, you won't be seeing out of the windows of the new house because it's just not going to happen. So properties go usually list price plus above. A lot of times a property is listed low intentionally. So don't get excited. It's like, oh yeah, this property is, on the market, it's cheap, or, well, I won't say cheap, but it's inexpensive of what you're typically looking for, because more than likely the final sales price will not be that. But in your offer, it still has to make sense. So which we'll talk about that coming up. And then contingencies. A lot of times I've seen offers in this market that they're waiving home inspections. They're waiving what are they waiving? They're waiving home inspections. Oh, I just said that. Home inspections. They're waiving appraisals. They're waiving everything just to get the deal. Does that make sense? No, because I'm never going to tell you to waive all those things. I'll say shorten the timeline, but I'm not going to tell you to waive it, because it'd be that one particular time that the house isn't appraised. So let's talk about this. Okay, let's say a house is 300,000 and you decided to waive the appraisal. Okay, and the appraisal comes in at $295. That's not a huge difference. So let's talk about this. Okay, let's say it came in at $290 and the sales price is $300. So You could ask the seller to lower their price. They may be willing to do that, but let's say they're not. And also, well, you got to remember, when I originally said this, you did not have a contingency in place. So, doesn't really matter what it came in at. Without a contingency, you're agreeing to pay the difference. But let's talk about this. The bank is only going to lend you what the appraised value is, or the contract price, whichever is less. So if it appraised for more, they're not going to give you what the appraised price is. The only option with that is if you actually got a USDA loan, which I talk about that in my other video. But that's the only type of loan that you could get over the appraised value. But anyway, I digress. So what I'm saying is, you would be responsible for that $10,000 because the difference between $300,000 and $290,000 is $10,000. So if you didn't have a contingency in place, then you have to pay that plus your closing costs, because in this offer you did not ask for a seller concession. So that's a lot of money. So my point is, a contingency must be in place. So it's important to understand everything about a contract, and not just to get a deal doesn't make sense. Not unless, if you have the money, that's different. But it's important to understand all that, because there would be no way for you to get out of the contract if you don't have contingencies. The contingencies are there to assist you. And the seller, their thing is they want to remove any possible way that you'll get out of the contract, because they don't want any issues. And if you decided not to settle in that scenario, then you would lose your earnest money. And they could sue you for damages, possibly. So that's all I'm going to say about that. So let's talk about financing. So there are 3 different types of loans that you can get. You can get a conventional loan. So there are options if you're a first-time home buyer. There are options for 3% down, but depending on your income, you may not qualify for that. So typically, like the bare minimum is 5% down. Though there are other companies that offer 100% financing with conventional loan. So FHA, you have to put down 3.5%. So that could be with a down payment assistance program. A lot of those programs, you don't have to be a first-time home buyer to use it. And if you're a veteran, then you can use a VA loan. So let's talk about this from a listing agent's perspective. So this is what we're looking at. So we're reviewing financing. So this is this house for, let's say it's a townhome, nice townhome in, Maryland or Virginia or DC, doesn't really matter where. So I have 3 offers. So I have the offer in red, I have the offer in black, and I have the offer in gray. So the first offer, let's talk about that, the red offer. So they are offering me the sales, in this example where they're saying that they're offering me the sales price. So they're offering me full sales price. They're offering an earnest money deposit of $4,000. They're doing a conventional loan. They're putting 10% down, which is $40,000. And they're closing at the end of July. And they're not asking for any money. Okay, that's offer number 1. Offer number 2 is a VA loan. They're putting $4,000 as for consideration. That earnest money deposit is also consideration. They're not putting any money down, because with a VA loan you don't have to put any money down. They're closing on the 7th of August, and they're asking for 2%, which is $8,000. So that's offer black. So the gray offer. So this is the final offer. So they're putting a little bit more. So they're doing $10,000. They're doing an FHA loan. They're putting down 3.5%. We don't really know whether they're doing a down payment assistance program or not. That's fine. Well, it doesn't really matter. It does matter, but that's not really important. And they can close sooner, though. And they're asking for 3% in seller concession. So, at quick glance, I'm looking at this from a listing agent perspective. When I'm comparing all these offers to my client, I put the pluses and minuses of all of them. So, with the first one, I would say, okay, they're putting down a little bit, well, not a little bit, they're putting down $40,000. I would probably recommend that they submit a higher earnest money since they're putting down 10%, if that's possible. But at quick glance, that's the better offer. But what is not mentioned here is what the lender is. That's what's not mentioned here. So I didn't want to go into what lenders I like and all that in this. This is just, that's another layer on top of this. So the pluses is the first buyer has more skin in the game, per se. And also in this scenario, nobody is asking for a home inspection contingency. None of them in this example. So the next offer, they're asking for $8,000, and then the FHA offer, they're asking for $12,000. So which one will net the seller the most money? The red offer, the black offer, or the gray offer? To figure out what that is, seller subsidy is what will be subtracted from the sales price. So the first offer is netting them the same, $400,000. The second one is minus the $8,000. So that's $390. Gosh, I can't add. $392. Yeah, $392. And the last offer is netting the seller $388,000. I'm sorry, the second offer is netting them $398. No, I was right, $392. So the first offer is the best, even though the last offer can close quickly. So, but this is the thing, you have to submit your highest and best. The last offer, they probably didn't need seller subsidy, but they asked for it anyway. So, but because I mean, it's at the end of the day, it's the seller's option to choose which offer they think the best, but they're going to look for guidance from their agent to say which one is the better offer. So if it was me, if it was my deal, I would probably move the FHA offer away from the table. And look at the two. And you compare the two side by side. Depends on which one you actually want to work with. Now, can the VA loan close sooner? Maybe, maybe not. Depends on what my client wants to do. Then we have additional options to negotiate. Is the buyer going to let my client stay in the house because they need more time in the house? So it's a lot of things that goes on in the back end. But the red offer is the best because that's netting my seller the most money. So the point of this is to show you that you need to look at, yes, you want to have it as a win-win, but remember I told you in the beginning, it's a seller's market. So the win is to get the house with the contingencies that are going to protect you. That's the real win. Not, oh, I want seller subsidy, because it's not going to happen. It's not, no. It's possible, depending on the market you're in. But if you're in a very competitive market and there's not that much inventory, don't count on it. And if you need it, do not enter the market. That's my recommendation. So let's move on. So offer review. So what type of financing are you using? Have you submitted a buyer financial questionnaire? So some offers you have to submit your basically snapshot of where you work, how much assets you have, and all that. How much money is your earnest money deposit? Is it 1%? Is that enough? Could you do more? If you could do more, you should. That shows that you are serious. Not saying you're not serious because you're writing an offer. That is serious. But that means that you are not willing to, quote unquote, walk away. If you do $1,000, I mean, they're probably not going to accept that. But the more you do, the better your offer will look. How quickly can you close? Is your loan going to take 45 days? Is your loan officer responsive when the listing agent calls? Because the listing agent, if they're doing what they're supposed to do, they will call the lender. Are they responsive? Do they communicate? If I send an email, will they respond? Who is the lender? Is it an online company that's not local? It doesn't have to be a local lender. It should, but it doesn't have to be. You just, what have they actually reviewed? Have they reviewed do you feel confident that you'll actually close on time? How does what's your confidence level? Because in essence, you're putting your money on the line. You're banking on the bank, so to speak. If they can't deliver, then you are at risk of losing your earnest money, whatever that amount may be, whether it's $1,000 or $10,000. That's your money that's at risk. So that's important that you have a strong lender that's backing you, that's saying, okay, well, as long as you submit all of your documentation and you're clear to close early enough, then you will be able to close. So also, are you asking for concessions? Is that a wise thing to do? Is your offer contingent on inspections or other items? So property showings. So it's important in this market to be punctual, and because as of the date of this video, we're still in COVID-19. If you're watching this in future, hopefully we will not be in COVID-19, but as of right now, we have to have a mask, limited number of people, and you need to fine-tune your home search. It's essential that you are on time, because more than likely, especially if it's a hot property, we will either have to wait at the door for these people to get out of the house, or if we're not on time, then basically our appointment could get bumped and we won't get to see the house. And that would be, I won't say devastating, that would be bad because you've wasted gas money, you're already over there, and it throws off the schedule completely. So that's why it's essential that you are on time. So contingencies. In a contract, they're going to be your home inspections. So that could be typical home inspection, radon, termite, all that. Financing, and your appraisal. Even though you're pre-approved, you still need a financing contingency because things could happen. If the appraisal comes in low, so you still need to have that in place. But in a seller's market, sometimes buyers are omitting every last one of these items. No home inspection, or they'll do a home inspection with for informational purposes only. So that's okay. I'm okay with that. To omit it, I don't really want to do that. That's not wise. Financing, you could shorten the time frame. Instead of having 30 days, so it's basically you're telling the seller, okay, well, I'm approved, but the lender hasn't given me a commitment and 30 days from now they'll do that, and then that's when we're closing anyway. So basically, from the seller's perspective, it's like, well, I'm taking my house off the market for you because you told me you're approved, and if you're not approved at the end, then that causes problems. So the shorter that is, even in a non-seller's market, the better. But it is what it is. Can your lender deliver on that? So whatever you put in the contract, you need to make sure the lender can deliver on it, or your vendors. If you have a home inspection that you say, okay, well, I want this done in 3 days, do you have your home inspector lined up to be able to do that? Because that's the inspection and report within that time frame. If you deliver it after that time frame, you cannot ask the seller for anything, and you're basically stuck with what is going on with that house, and you can't do anything about it. And appraisal. The home has to appraise at this particular price, or you have to reduce the price. And if it's not a reduction, then you can get out of the contract. But if you don't have an appraisal contingency in place, then you will have to pay the difference, if there is a difference. So that's all. Thank you for watching on understanding what a seller's market is. I hope this was informative to you and that you learned something. If you have any additional questions, don't hesitate to call me, 240-284-4114. Thank you.